Hello, welcome everyone to another edition of the EA Forum podcast. I'm delighted to be sitting here today with Frans Pettinga to discuss some of the really interesting developments in the metals industry. I think it's a super interesting environment at the moment. There's a lot going on, from tariffs, safe haven flows, inflation flows. We're seeing commodity trading shops really scale up their businesses in this space around some of the longer term kind of demand themes. And who better to kind of unpack some of the themes with us than Frans? So thank you very much for coming, Frans.
Thank you. A pleasure to be here.
So Frans, you're a seasoned executive, right, in the commodity trading business with a particular expertise in metals. So do you want to just kind of talk us through some of your career highlights and maybe what you've been up to?
Yeah, I started in the metal space, I guess, when I first started my career in trading, which was at Cargill. That was in the mid-'80s. And Cargill was a very fundamentally oriented shop, very focused on process over short-term P&L. And so I think that gave me a good grounding in trying to remain objective in trading markets. I was at Cargill in the mid-'80s, like I said, and mainly a physical business. I think I found myself kind of attracted to the futures markets during that time. We were running a hedging book, and I think in the physical markets at that time, there's a fairly significant lack of volatility that was pre the China growth story, post the tin crisis. And so eventually found myself moving to the LME brokerage futures side, worked for a couple of shops there, including Billiton and Lehman Brothers. And then eventually ended up going to Koch Industries in 1997 to start up a metals business, which was originally just in base, now has expanded into precious as well. That business has now been in existence for just over 25 years. I actually haven't been at Coke since the end of 2018. I retired from there. So I'm really just managing my own capital with a few partners. I'm still, obviously, as a trader, never lose interest in the markets, but doing a job that's a little bit less intensive than running a trading business, a global trading business.
Oh, fantastic. And obviously a lot of those themes, over the years with different kind of trading cycles, I think super relevant to today with kind of what's going on. We're seeing traders get hit with kind of every kind of macro and micro themes all at the same time. And obviously some of those micro themes are quite specific to the contracts in the metals industry and how it actually operates. And given most of our clients are predominantly, let's say, from the energy kind of side of things, I think it's worth highlighting maybe some of the key differences between the contracts, the specs, how storage really operates in the metal space, and the differences between some of the major exchanges, so that we can link it to kind of some of our discussions as we go through.
Yep. I mean, I try and maybe talk a little bit about the qualitative differences in the metal space, which I think, make a difference to how price setting mechanisms work. I think, and this goes back to, my experience of looking at metals first and then having some involvement with looking at the energy space when I ran the overall business at Coke, and seeing the contrast between which trades worked, which trades had different price setting mechanisms or clearing mechanisms. And I think I'd say, looking at metals generally, I would say that a couple of things that are important are the durability of metals, the general homogeneity of metals, meaning that qualitative differences between regions are relatively limited compared to a lot of the energy markets. And I think cost of storage and transportation being relatively low compared to the value of the commodity as well is quite an important part of how prices and connectivity between global markets work. Now, up until recently, I would have said that one of the other differences is that in energy markets, politics play a greater role in terms of understanding risk. And of course, recently with the whole tariff story, that's something that's coming into the metal space as well. And I think it's a clearly a new phenomenon that people in that market are trying to deal with and quantify. But like I say, I think in terms of how, that dynamic of underlying, qualities of metals affects pricing, I do think the opportunity set in metals around quality, location, and timing trades is impacted by those differences to the energy space. And I think what we've seen in the recent months, for example, dislocation between COMEX copper and LME copper and CME gold and London gold are a little bit unusual and probably unlikely to be continued for very long times.
I mean, that was one of the interesting things when I kind of came to the metal space, dealing with, even just on a contract basis, the difference between, LME forwards or futures, COMEX futures, the different timing periods, the different settlement processes between the two, and the differences in the actual storage of the two exchanges. And those seem to be playing out today, and why we're seeing such volatility between the two sets of prices.
Yeah, I think between COMEX and LME, there's always been, as you point out, there's difference between the LME not being a cash settled and cash cleared market in the same way that the CME is. In fact, you could argue that LME futures they could be or have been considered in the past to be forward contracts rather than futures contracts, because they're not settled on a net present value basis in the same way that, say, COMEX contracts are. And that's always created a different participant stack between those markets. So some of the arbitrage in the past wasn't necessarily due to the fact that there were qualitative differences between the two markets in terms of copper in Europe and the States being different, but more about the fact that, for example, the market in the US is a domestic market with customs cleared metal. The LME was a global market where all the storage is in bonded facilities, meaning that even though it's a global network, the metals, they're actually all of them not cleared for customs purposes into the countries in which they're located. So I think those dynamics have an impact on relative value between those markets. And in terms of participants, I think in the LME case, I would say that a lot of financial players have struggled in the past to get comfortable with, a couple of different dynamics. One is the non-cash settlement, cash clearing element, which meant that, everything had to be looked at on how you could adjust it to MPV. And obviously that is an extra step that you don't have to take when you're dealing with the CME. And then also the fact that you had this date system, not the monthly delivery contracts. And I think, those have been idiosyncrasies which have been unique to the LME. I'm not sure if they're necessarily giving the benefits that they used to in the past. So in the past, the reason the forward market existed was that it gave the ability for producers and consumers who were hedging to match their cash flows to their hedges. And credit lines would be provided by brokers in the meantime to allow for people to carry positions as hedges without having to necessarily put a lot of upfront cash to work. And I think that system worked pretty well. But obviously, since the financial crisis in 2008-10, regulators have become increasingly focused on making sure that people had enough cash collateral to support positions. So I would argue now, actually, that the benefits that existed in the past have been a little bit eroded, just because, for example, today, if you're a brokerage firm and you deal with a producer or a consumer, you're not allowed to aggregate those positions with your own in the same way that you used to be able to. And so the netting effect amongst positions is a lot less than it used to be. So the benefit of having the deferred cash flows, I think, goes away with the fact that actually you have to produce cash collateral upfront on day one today, just given the way that the market, the clearinghouse today administers positions. So I think that's an important change to the underlying dynamics, and maybe that's something that the LME might look upon, because I do think having those sort of special qualities for the LME contracts and looking at them whether they're still providing the benefit is a worthwhile exercise. And then on the warehousing side, we have a date system, which obviously in theory allows people to fine-tune their deliveries. But the reality is that we also have a warehousing system where the most of the markets where you have significant inventories have significant queues, and so therefore you have this sort of mismatch between what is a daily contract and actually, in theory, a daily delivery system, but actually not really having the ability to execute on that in a physical way. And I think that has undermined the convergence between, for example, the LME and the physical market, and that's created some of the dislocation between futures prices and physical prices over the last few years.
And do you think those inefficiencies are really driving some of the volatility that has been, let's say, tariff driven? But a lot, it seems, dislocations between the two markets is coming from maybe the different kind of systems within those markets.
Yeah, I mean, obviously, with the recent tariff speculation, I think, if you compare, for example, base metals to gold, I mean, I think it's one reason that gold has seen the focus for those moves is because out of all the commodities that you that have globally, the absolute lowest transportation cost relative to value is in gold and silver. So, well, mainly gold. So it's not surprising for me to see, well, if you've got a potential tariff coming in a country where you can shift your metal reasonably quickly, and gold is by far the quickest and the least expensive to move, then that's where the focus of the activity is going to be. We've obviously seen some moves like that in copper, and I think, my sense is, talking to participants in the market, that most people who are trading physical in that space are being very cautious about taking too many assumptions around what might happen. And I think that's fair because, I don't think physical trading houses are particularly, competitively advantaged in predicting outcomes on what happens to tariff policy. And so I think at this stage, there is obviously a very wide and volatile arb, which is unusual. But I think that if you look at the liquidity in that space in terms of being able to physically transfer units across, with copper compared to, say, gold, there's a good deal more time involved. Yeah. And at the moment, given the fact that things are changing daily in tariffs, I think that means that the connection in gold is working much more efficiently than, say, for example, in copper.
Okay, yeah, seems that way. I mean, we've definitely seen a huge increase in COMEX gold stocks, right? And the arbitrage kind of makes sense with limited transport costs and a heavily contango market on the CME, kind of encouraging people to store there. And the contango is giving a double yield than the cost of money at the moment.
Yeah, so I think it's interesting, if you look at social media these days and look at what's going on around the gold market, there's lots of speculation, about the increase in CME stocks and lots of people talking about, the US demanding metal. I look at it slightly differently. I think the reality is that the CME has had an influx of metal because it's a relatively, cheap option to ship metal across on the basis that, well, worst case, it could happen, you ship it back. But at the same time, if a 20% tariff comes in, you've obviously got a huge upside. So I think that's something that makes a lot of sense. But I think where the CMEs see these big inflows, now obviously it needs to incentivize people to finance that metal because, it's now moved all to one location. So I think the wide contangos are actually a reaction to the fact that there's excess availability of material, and so in order to to get people to step in and take delivery of notices, for example, you've seen contangos, like you say, widen to implied interest rates, which are very significant relative to cost of money. So I think it takes a while for people to understand what's involved with trading that, but my own sense is that that will eventually get arbed out because I think, if you have the ability to, convert your cash to gold and sell forward futures, the secondary consequence of the arb of moving gold across from Europe to the States is the fact that you've got this cash and carry arb.
Yeah. I mean, it's a really interesting dynamic in gold at the moment where you have this physical underlying kind of dislocation movement kind of going on, but you've also got some of the biggest ever speculative positions in gold. We've seen a lot of hedging from the inflation aspects in the last few years, but we've also seen huge safe haven demand. And gold is back to trading with things like Japanese yen and Swiss franc as kind of increased risks from either a recession or kind of global risk off arise. But we've also got it trading with Bitcoin and things like that again. And we're actually seeing now traders, given the inventories in the COMEX, putting on loads of hedges with puts. I think every time you see gold rise now, there is a level of nervousness as gold prices, hit record highs and things like that. I mean, do you think eventually the inventories on the COMEX side could actually lead to a bit more, let's say, downside skew arising on that contract?
Well, I think we've seen a few unusual things in gold, right? First of all, generally speaking, gold has been, affected by the value of the dollar. So as dollar has gone down relative to other currencies, gold has generally been supported and the other way around. And clearly last year or so, gold has been strong along with the dollar.
Yep.
And that's an unusual phenomenon. I would say that, the general shape of the gold market is an important consideration for those who are holding long-term investment positions, because there's an opportunity cost element, which is, the contango. And clearly, if you look at the price of gold today and you look at the shape of the curve, there's a very significant, there's an interest rate related, but also now a premium to interest rate related contango, which means that if you're financing or holding a long position, that's chopping away at your return. And in the past, I would say that contango shaped markets like that have found headwinds at some point. Now, one thing that we haven't seen, as far as I can tell so far, has been that curve shape attracting a lot of forward hedging. Now, and actually, that's kind of the irony of these situations. You get a strong commodity price environment, you'd expect hedging to increase, but actually the opposite occurs. Producers feel like they owe it to their investors to give them the upside exposure. They also feel comfortable with their own cash flows, so they feel less incentive to hedge. But the shape of the curve in gold right now means that, with relatively high interest rates and a high price, if you take the 4 or 5 year forward price and you look at that and you look at cost of production, there's mining stock share prices seems to be a pretty open arb the further out you go, right?
Yeah, that's really strange. I mean, do you think there's anything else behind the discount in some of the mining stock shares relative to the outright?
I think one thing that people might be overlooking is that, most of the gold production in the world is not in the US. And, the gold price that people are looking at is the COMEX price, which is in theory a price that might include some tariffs, right? I mean, to the extent that that might happen. Now, I might argue that one of the reasons that there's a bit of a discounting is that people are looking at those two, separate parts and recognizing that implicitly in the high gold price right now is an element of tariffs. And to the extent that you're outside the US, that's not something you're going to realize as part of your return. So there may be an element of that. But like I say, I mean, there's lots of interesting idiosyncrasies going on where gold futures are behaving differently from where they might otherwise behave. Like I said, relative to the share prices of mining companies, but also relative to things like the dollar. I think, there are some risks, I think, in that equation to liquidity events, and I'm not surprised that people are concerned about hedging that, because that can happen very quickly.
Yeah, particularly with these the size of the relative positions. I mean, even retail have been getting in again on gold. It's become very loved. I mean, I think I looked at my numbers this morning, and nearly $5 billion of ETF inflows on the physical side this year. But in contrast to that, actually, silver looks a little bit unloved. That's actually one of the only precious metals seeing retail outflows this year. And silver, given kind of where a lot of its production is in Mexico, should actually be more impacted by tariffs than gold to a certain extent. Do you have any thoughts on why silver is kind of relatively stuck in the mud, I would say, compared to gold?
I think it comes down in some ways to the fact that, some of the big drivers to the increase in gold prices have been around, concerns around the value of fiat money. And I think, when you look at the precious complex, gold is clearly considered to be the money alternative. And silver has this slight hybrid between being, on the one hand, a money alternative and on the other hand, a commodity.
Yeah.
And as you say, I mean, fundamentally, it looks like the silver market's got some pretty good tailwinds. And so in theory, you'd expect that to translate to, a bigger price support. But I think, like I say, it perhaps is explained a little bit by the fact that it's considered to be more of a commodity. And if you look at the other metals, for example, whether it be copper, aluminium, zinc, or nickel, actually right now they're all kind of struggling a little bit. So that I think is part of the reason why silver may be underperforming.
Yeah, well, that brings us perfectly into those other metals. I think copper has been one of the most interesting stories this year. I mean, it's had tariff noise, and a lot of that's playing out in the differences in the price between the CME and the LME. I mean, prices got over $1,000 a ton on the ARB. There is a lot of relative value flow now, right? And the ARB seems to be attracting a new type of capital. When I speak to metals traders or I speak to brokers, they're seeing new participants on the ARB. And you've also got differences in the systematic flows on the ARB. You've had a lot more buying from CTAs on the COMEX side, which have been supporting that ARB, but it's also making it a lot more volatile, right? As a lot of those systematic flows between the two contracts exacerbate, I think, some of those moves. So you kind of mentioned earlier that this might be a little bit short-lived, kind of post-tariff, and it already looks like there is some fading of tariff news on the COMEX contract. Do you think after these, let's say short-term noises have gone, those two contracts will kind of normalize?
Well, I think the problem is that it depends on what the outcome is on the tariffs. And I think, one of the issues that we're having to deal with, and I think one of the turbo boosters, shall we say, to the movement in the arbitrage more recently was the fact that the administration in the US imposed commodity-based rather than country-based tariffs when it came to steel and aluminium.
Right.
And up until now, I think most people have been looking at, which countries are going to be affected, what's their production, how much of the imports are they. But I think realistically, the market understands that, if tariffs are imposed on a country basis in commodity markets, generally speaking, all that will happen is that the countries that haven't had tariffs imposed will see their metal flow into the country that doesn't have those tariffs. And that's why one of the reasons I think the administration in the US probably chose to impose the tariffs as they did on the commodity rather than on countries. And it's going to be very interesting to see what happens in the next few weeks, in relation to things like copper. Clearly, there was an announcement last week about the fact that the administration is looking very seriously at copper. And I think, to my mind, if you go down the route of imposing a commodity-based tariff rather than a country-based tariff, then that's a pretty binary outcome in terms of what that means for the value of COMEX metal relative to LME metal.
Yeah. That's really interesting that, when you said a lot of governments now looking at copper. I mean, we've got this, the thematic kind of backdrop being, the energy transition is going to take, a lot more copper. There's not a lot of mines coming on. And it seems that, copper being the base of why a lot of commodity trading shops are now starting to really ramp up their exposure to metals. We've seen many of our clients, core energy clients, getting into metals trading. And it was really interesting at our conference that we had last year. We had a trading panel, and all four of the panelists were senior trading leaders in energy. And we actually asked them, if you could put any trade on now, what would it be? And every single one of them actually said long copper. So what do you think to this kind of thematic kind of backdrop of how trading firms are now shifting and around the energy transition? Is this likely to be something that plays out in the short term, or do you think this is much more of a longer term theme?
Yeah, it's tough. I mean, I think, as we talked about at the beginning, I think the qualitative differences between metals and energy, I think, give a rise to different opportunities. So if I look at the buckets of risk-taking, that the five main buckets, which I consider to be price, timing, location, quality, and volatility, right, then I would say that in my experience in the metal space relative to the energy space, quality, location are generally speaking less volatile because traditionally there's been greater interconnectivity between the markets. Now, to the extent that you introduce tariffs into that equation, then obviously that might change the formula. But I think one challenge I would have is that it doesn't necessarily give any one player a particular competitive advantage, unless, for example, you're an asset owner in the US, for example, and you're protected by those tariffs. So I think in terms of, the energy space or the energy trading companies looking at the metal space, my own sense is that, if you're seeking price exposure, then I think, the barriers to entry on that are fairly limited. I mean, anybody can go in and create positions in that way if they wanted to, either through ownership of copper producing assets or through trades on the market. As for building a trading business around that, I guess my sense is that the marginal added value from doing that in metals might be a little bit more limited. I think if you look at the history of the last 5 years, if you go, what does merchanting activity give you, right? It gives you a return on your bid offer as you build a franchise. But I would say that generally the history of trading will tell you that that's very heavily competed. And so you get two other things from merchanting. One is you get a degree of optionality, and two is you get information flow. And I think, again, my own sense is that the marginal value of information flow has probably been declining because the world is more interconnected. People have greater access to information, which previously would have been considered proprietary. So then it goes back to the marginal value of optionality. And I think, in the energy space, we've seen in the last few years very significant dislocations between regions, very significant dislocations between different qualities, which have given people super returns from those activities. I would say in the metal space, whilst we've seen, some of these tariff-driven opportunities more recently, and whilst I think there are idiosyncratic differences between, for example, the LME and COMEX and the Sheffield exchange and the Shanghai exchange, which do give rise to occasional arbitrages, I think the underlying qualitative differences of the metals complex are going to, make the upside in those types of plays, less sustainable than you would see in maybe the energy space.
Okay. So whereabouts do you think maybe physical optionality does lie in the metals space, and where are we likely to see volatility perhaps in that supply chain?
Well, I think I have to maybe think about the secondary consequences of tariffs. So if you look at what's coming through right now, and, obviously we're seeing tariffs right now as being a US issue. I mean, who knows what happens in response from other countries. And that's something maybe as well that maybe people need to think about. Everybody's focused on the US being the imposer of tariffs. There's obviously the possibility of retaliation the other way as well. And so that's something that I think needs to be factored into thinking about risk. I would say, for me, looking at the broader picture, I don't see the metals markets in terms of having, well, for example, if you are focused on primary metals and you have a situation where primary metals are attracting the tariffs, there is in other commodities or in other areas where tariffs have been imposed, there's generally a consequence, which is that the products which have metal contained, whether they be semi-fabricated products or raw materials or actually finished goods, tend to then find ways to get into those markets on the basis that they don't qualify for the tariffs, right? So I think one of the things that you'd expect to happen is, potentially there would be an increased flow of things like scrap or an increased interest, at least, to look at scrap as a way of circumventing some of the worst effects of tariffs. There might be an impact on, the desirability of buying or selling semi-fabricated products, because they may, again, not attract the same level of tariffs as the primary metal. So I think those are all secondary consequences which may occur if those tariffs, kind of prove to be long-lasting. Because that's the other big question at this point in time. I don't think anybody really has a clear picture as to whether these are likely to be temporary issues or long-lasting issues. And I think that's a big challenge right now. And certainly from my conversations with most of the traders that I'm in contact with, I think people are taking a bit of a step back and waiting to see what happens.
Well, that's really interesting. I mean, I think maybe you can pivot a little bit now and just think about your experiences of running a global trading business as well. So you've got a lot of experience in this area. Obviously, the last 8-10 years have been punctuated by global pandemic, a war, and now we've got tariffs. How do you think about, and given your reflections, managing risk in these environments, and where opportunities actually arise from, and how actually the modern trading organization takes advantage of them and positions for, given we have a slightly different kind of world, I guess now, where the amount of financial capital in commodity markets is significantly scaled up, whereas perhaps a decade ago, the biggest trades sat with the trading houses. And I think today it's really split. You have the hedge fund world that has really ramped up, but also into more fundamental bets as well.
So, I think going back to how I tried to, build the metals business at Coke and how I tried to, run the overall trading business in my last few years there, I've always tried to look at the trading business. I mean, some people would describe the trading business as being about predicting outcomes. But my sense has been that, first of all, that's challenging, but secondly, I'm not sure that necessarily that's how I've experienced it. I think, generally speaking, trading companies... Or I think the best way to think about trading is, you're paid to connect global dots, and I think the way that you have to look at opportunity is to figure out, what the problems are that need solving and whether you can create the capabilities to solve those problems and get a return that's adequate relative to the fact that, you may not necessarily get paid back for things like optionality or information. So you're looking, first and foremost, is there a bid offer here I can collect, and does it give me a reasonable enough return so that I can sustain this business in a way that allows me to benefit from the fat tail upside events when they occur. And I would say that, there are a few things that you have to look at in that. And my view is that, you have to understand which buckets of risk you're looking at and whether or not you can create competitive advantage. I would say, for example, with regards to, traditional trading houses, location, quality have always been, and seasonality to some extent have always been sort of core trading strategies, and I think that's where they've had their competitive advantage derived from their merchanting activities. I think hedge funds, generally speaking, might struggle with that on a relative basis. They may not have the physical optionality, for example, to take delivery or to fund inventories. On the other hand, on price and volatility, I would say that, that if you look at the recent history, for example, of how certain hedge funds have managed to build very significant P&L flows from things like gas, you could probably argue that in those areas, merchants are just one of a number of players that are providing capital, and perhaps their competitive advantage derived from their footprint on the merchanting side in those areas is not that great. And I think we talked about it briefly before this meeting. I think last year on crude was a good example. A lot of people that I spoke to on the physical side of the market were pretty friendly towards what they were seeing around inventories, and generally speaking, probably had a slightly bullish bias for most of last year. And, as it turned out, I think pricing underperformed. And I think, like I say, it goes back to understanding how you create competitive advantage and what the limits of that competitive advantage are. Because I think, ultimately it's about having, two strands, right? You have your merchanting activity, which creates your rateable income, and then you have your potential exposure to upside events when things, when you get the tailwinds. And of course, in the last 5 years, we've seen a couple of those big events, which is one of the reasons why obviously commodity trading companies have done very well.
So as we discussed, the trading firms today, are changing a bit. We're definitely seeing kind of the oil traders, move more into assets and credit and things like that. Where do you think kind of, that transition is going, and where some of the opportunities are in assets? I mean, we've seen oil traders, buying refineries or buying even renewable kind of production and things like that. I guess it's all about optionality.
Yeah, and I think as we touched upon in the previous discussions, I think, the value of optionality, I think, is highly cyclical. And I think it's also likely to be different for different assets. And so clearly in the energy space, you've seen some assets, provide very high levels of optionality, gas storage, for example, or refining even. I would say, high level, I think my own sense is that generally speaking, as people have built cyclically significant earnings, they've sought to, divest some of those earnings into acquiring assets. And I think part of that is around optionality, but also I think it's partly around the fact that people are expressing, a point of view through assets. And I think there are some benefits to that. I mean, at a high level, I would say the main benefits of being a trading company is that you can deploy your capital opportunistically to the area where, you see the biggest opportunity. And I think to the extent that you are building a big asset portfolio inside your business, I think that's fine, but I think you reduce the ability to move your capital opportunistically. And so I think the question you have to ask yourself is, is that something you want? I think the other challenge that comes from having an asset portfolio alongside a trading portfolio is it can be challenging to measure marginal value added. And so, how do you deal with the challenge of recognizing whether actually you're deploying your capital and resources wisely when it's very hard for you to understand whether, the thing that's created the value is your asset position or your trading position. So I think, having some degree of separation in place to allow you to be objective around that, and to also potentially be in a position where instead of looking at assets as being, long-term holdings, but actually look at them as being opportunistic as well, and perhaps seeing opportunities to divest when you think that the upside in the cycle, is less attractive. So I think, it's understandable why people are doing it. I think that especially if people are considering going into public markets, it makes sense. I mean, public markets have traditionally discounted trading income relative to asset income. And I think, that might be unfair because I think if you've got a decent trading franchise, a lot of companies can prove to sustainability in those earnings. But I think that's the reality. So if you've got a strategy to go public, one of the greatest examples of that probably was when you saw, Glencore go public, and having a big asset portfolio definitely helped to raise the valuation of the company. So, to my mind, I think, there are pros and cons. I would say, at Coke, where we were, we generally speaking adopted a philosophy of looking for other ways to control the benefits of being an asset owner without necessarily being an investor ourselves. So, there are hybrid solutions out there where you provide, for example, security of income through offtake agreements or through price protection that give you some of the upside of being an asset owner without actually operating the asset yourself. And I think, to my mind, it's easier in those types of arrangements to keep transparency around where the money's being made.
That's really interesting. So it sounds like, a source of edge is coming from trading the asset, not just trading around the asset as well.
I think so. I mean, obviously, we've seen some super returns because, you've seen very significant events that have given those assets, what would probably be considered to be unsustainably high levels of returns. But clearly, if you look at the history of the markets and how people have ended up owning those assets, in a lot of cases, they've also carried them through, pretty painful times during cyclical downturns. So I would say that, if you look at the last 20 years and you see how people have looked at asset portfolios, generally speaking, I think they've had a positive experience. But again, if you look, for example, recently at the results that came out of Glencore, and you see some of the write-downs that they took on some of their big asset portfolios, those things can work the other way as well. And I think, there's a sort of balancing mechanism. And like I say, I think the last thing I would say from a management point of view, my experience is that optimizing assets and optimizing trading also requires slightly different skill sets and mental models about, how you function in the world. And I would say that they're not necessarily opposite, but they're sometimes conflicting. And if you're an independent trader, for example, and you do own a large asset portfolio, I think it also potentially undermines your ability to be, a third party that people feel comfortable with because there is no conflict, right? And so that's another factor to consider, I think.
I think that leads us nice into the next point, because I was thinking, actually what we're seeing in many trading firms today is they're not just building portfolios of assets, they're building portfolios of traders. And I think some of the ways potentially like a multi-strat hedge fund would work is now, we're starting to see a similar setup in some trading firms where they look at different unique aspects of traders. So how do you think about, as a trading manager, developing traders for edge? Or how do you look at whether a trader has edge and putting them in a portfolio together? And thinking about how you run traders per se.
Well, I think I touched upon it before. I think having exposure to different types of activity or different asset classes or different regions does give you the benefit of carrying the entire business through periods where some of the businesses will be eking out an existence. And so, I think if you're trying to deal with the challenges of being in the trading world, one of the biggest challenges is, sustaining yourself through low marginal returns. And having a bit of a portfolio, I think, can help you, smooth out some of those ups and downs. I think in terms of traders and where I've learned which traders have functioned the best and where traders haven't worked well, I would say, fairly kind of high level observation would be that, some of the best traders I worked with were traders that understood very clearly what they didn't know and understood how they had to recognize that, there were certain things that were going on in their markets which looked very attractive. I mean, generally speaking, for example, around price movements or outright price movements, rather than, relative value or qualitative moves where, you could get sucked into thinking that actually because you knew that, inventories were going to go down or you knew that something was happening regarding a certain supply issue, you'd have an edge, for example, to predict pricing. And I think, that's sometimes a very hard temptation to resist because if you get a price trade right, then, it's relatively the most straightforward trade often to put on and to take off. But I think, my own experience is that, understanding and having the humility to understand whether that's through luck or judgment, I think is something that's really important. So having a regular process to understand whether actually you've got a competitive advantage, really being hard on yourself and recognizing where you've been lucky or smart, I think is a really important part of understanding, how to create sustainability in your earnings and avoid, getting into a situation where actually you have a great business, but you end up diluting your returns because you end up doing stuff that you don't really have a competitive advantage in.
I think that was really interesting. It just brought back memories to me then of filling out those trade management sheets at Coke back in the early days and having to go through the framework. But I think having that rigorous framework, actually, it's probably one of the things I learned at the start of my career that I've taken all the way through is actually having a process and a rigorous process around trades, but it kind of did feel like doing your homework at sometimes when you're getting marks on them.
Yeah, but I think the overall objective was simplification. I think, if you're living in a very complex world and you're in a situation where you're dealing with so many variables, it's very hard to count, which ones you're incorporating. I mean, a lot of people, I think, struggle to express in plain language what it is that they're betting on. And I think another fact that, I came across is a lot of people really didn't necessarily understand what their underlying assumptions were that were implicit in their bets. So, for example, if you take a simplified trade in which somebody was forecasting that, inventories were going to, for example, decline and then had a price bet on, the implicit assumption is that lower inventories will lead to higher prices, right? But sometimes it's good to talk about what those implicit assumptions are because actually what I think a lot of people have learned the hard way in, the past few years, as, for example, new capital has come into the market, is it presents an opportunity because you have more money coming into the space and it creates opportunities for certain dislocations to occur. But it also leads to an ending of your assumptions, right? Because the relationships that you may have gotten used to are now very different because of those flows. So I think, the overall phenomenon that I've witnessed is that having an explicit discussion about what your assumptions are, trying to quantify things that you may not have thought about, and Charles Cope was always good about reminding us that, things that you can quantify are the ones that you tend to focus on because, things that are easy to measure are easy to talk about. But actually, that doesn't mean that the most important variables that you need to be focused on. Sometimes the things that are difficult to quantify are actually the most important. So having some process or some discussion about what that might look like and whether or not you still feel comfortable with the overall upside downside, I think are really important. And then lastly, I think, there's a lot of human behavior biases that occur in, every business, whether you're a hedge fund or a trading business. To my mind, I think, one of the things that we learned as well is that, there is probably a very limited correlation between levels of conviction and outcomes. And what I'm trying to say by that is that, sometimes people would be very highly convicted about a trade and size it accordingly, and less convicted about a trade and again, size it down accordingly. And actually, I think in our experience, because there was actually not particularly strong correlation between the actual outcome of the trade and the level of conviction, it's probably better to introduce some objectivity around that and to be a little bit more consistent in how you apply yourself. And that hopefully over time also improves the results from the portfolio.
Perfect. So speaking of high conviction, where do you see kind of opportunities in the investment space or in the commodity space today, for the next few years? What kind of things do you like from a return perspective?
Well, I think on the trading side or on the brokerage side right now, the fact that you've got new flows of capital coming into the market, I think, is a positive. I think it's a risk in the sense that you've got to recognize that that's going to affect the way price setting mechanisms evolve. But I also think, generally speaking, it should allow for more dislocations to occur between, for example, physical and financial markets. So I think that's, generally speaking, a tailwind for either a brokerage company or a trading business. I think on the commodity side, my own sense is that it's extremely difficult to make future predictions. I mean, if you look, for example, at the battery metals in the last few years and some of the investments that have taken place in, say, the lithium or cobalt space and see what the price performance there has been, it's a tough gig, right, to make those forecasts. I do think looking at market structure and thinking about what opportunities are, I would think that people should be having conversations at mining companies on the precious side to look at that forward curve and to recognize that there's a pretty strong incentive to be counter-cyclical, not to wait for the downturn, and to actually think about whether that forward contango gives you some pretty decent opportunity to lock in some of those supersized returns. And that's probably a discussion which is difficult to have because, mining companies, like I said, right now are feeling that they owe it to the shareholders. But I think from an optimization point of view and a risk reward point of view, I think there's probably some value in having those conversations. And then on the copper side or on the aluminium side, I mean, look, we've seen a period of pretty choppy sideways markets. I think it's a very difficult picture because you've got some tailwinds in theory from, some of the energy transition market developments. But you've also had some headwinds which, have come around, for example, around the general growth in China, around tariffs. What does that create in terms of, outcomes around global trade? So I think it's a tough one. I think in the short term, I think you've got to remain relatively opportunistic and recognize that, the lesson of the last 5 years is that the future is very hard to predict. So keeping some degree of flexibility in the way that you allocate your capital, I think, will continue to be an important part of maximizing your returns.
Spoken like a true trader. Well, all that leaves me to do is thank you very much, Frans, for coming in and talking to us today. It's been an absolute pleasure. I've learned a lot. So thank you.
Thank you.